One of the best ETFs known for mankind are Invesco QQQ, which has an outstanding 10-year average return of 17.38%. VGT has also incredible 10-year average return of 19.6%, and VTI has a 10-year average return of 11.15%. Every competent investor understands that having all three of them in your portfolio will skyrocket your return of investment and will make you a lot of money. Average of these three is like a 15% return of investment, and by investing only $500 per month for 25 years, just like that will make you over $1.3 million. And that's just by investing $500 per month. And to be able to make returns like that, every investor must make sure that they cut any mistakes they possibly can. And in this video, we are going to cover 3 massive mistakes in ETF investing that could very easily set back you for years in investing. And of course, we are going to talk about how to fix them as well to make yourself in a very good position to becoming financially independent. First, we have to start about total returns. Here's where the problem is hiding when you start looking only for total returns. Well, I have you example of 3 ETFs in the beginning, and everyone know they are 3 very solid ETFs and each of them had amazing returns. However, picking top ETFs with best returns for your entire portfolio might just be a biggest mistake you can ever make, and in this video we will explain why. When we start looking at these ETFs we were just talking about, first comes QQQ. QQQ ETF is very big in technology if we are talking allocations, over 50%. Top holdings are very well known and reputable companies like Apple, Microsoft, Amazon, Nvidia, Meta, Broadcom, Alphabet, Tesla, and Adobe. Now, if we start to look at other ETF, which is VGT, and its investment allocations are 100% in technology. So the position overlap is huge, since we see the same companies like Apple, Microsoft, Nvidia, and others. And those companies which duplicate has the biggest percent in the fund as well. So when we compare the overlap between these 2 ETFs, we can see that 33% of QQQ holdings are also found in VGT. If we are looking even further, the weight between these 2 is 49% as well. This basically means that you are buying almost the same thing just named differently, and also are getting charged double fees because you are buying different positions. You are buying QQQ, which is high in Apple and Microsoft, and then you are buying VGT, which is also very high in Microsoft and Apple. This might not seem like a big deal in the first glance, however, the specific way most of you are doing it might be very well be. And of course, we can't avoid the fund overlap when we are buying QQQ, which has high priority in technology, and of course the one which is basically called technology ETF, VGT. We will have similarity there for sure. One important thing, which most people like to forget about, is about foundational ETF like VTI. Most people start their investment journey with a broad foundational ETF like VTI, so it makes sense to check those 2 overlap. Most people already have VTI or VOO in their portfolio and add other ETFs on top of that. So, for example, QQQ versus VTI, we can see that we still have 39% overlap. So, if you are buying QQQ on top of VTI, you already have a lot of positions which are identical. However, the mistake is not specifically the overlap itself, as the most people would like to think so. That couldn't be further from the truth. If you buy 2 similar pieces, it does not automatically make it bad, especially if the positions you're buying in are so good and stable companies like Apple and Microsoft. Companies like these are very liked and appreciated in my portfolio, so it only makes sense to have a lot of these. So the problem isn't overlap itself. Problem is when you don't understand what overlap is and how can it affect your portfolio overall. Main takeaway from this point should be to understand what fund overlap actually is and how much overlap do you actually have. So in the example we went through included VGT, VTI, and QQQ. As long as you are aware of the holdings in each of these funds and how much of a percentage you actually own as individual companies in these funds, which ones are higher weighted than other ones, that's the important information you should be paying attention to the most. You have to understand that in each one of them you're investing into Apple, Microsoft, and Nvidia, for example. Having this information in mind, you should understand that if you want to add single stock to this ETF portfolio, buying another Apple stock is not the best decision most likely, since you are already very heavy into Apple when holding 3 of those funds already. However, if you do a lot of research and you really like that single company, for example Apple, this might be not the craziest decision to add that single stock to your portfolio. Interesting fact, one of the best investors of all time, Warren Buffett, have 51% of his portfolio invested in only Apple stock, which in his case is $178 billion worth of investment. With this case, I really want to say that as long as you understand the risk and company itself, it might be not the worst decision to go heavy on some particular company. If you found any value so far, please like and subscribe. Next mistake is also from a diversification side. However, this is one of the biggest mistakes I see for sure. Traditional way of investing is that you should not have or have as less as possible overlap. This type of investing should give you a perfect diversification, thus making it less risky to invest and easier to grow your overall wealth. Basically, in the old books, what we used to say is, if you invest into 2 things, they have to be totally different for it to work best to your advantage. Nowadays, almost everyone agrees that in a free fund ETF portfolio, a big portion of your portfolio should be US market stocks, for example, broad index fund like S&P 500 or the total US stock market. For the next fund in free ETF portfolio, we wanted you to have literally opposite fund of total US stock market. So in this case, international exposure like VXUS fund. And finally, the third fund has to be different than previous 2 as well. In this case, not even stock ETF. Third one has to be a fund which invests in bonds like Total Bond ETF BND. Obviously, the biggest mistake with this old free ETF portfolio is that we can now see the data of the last 20 years and it is not looking as good as everyone expected. Especially if we are talking about last 2 ETFs in this free ETF portfolio. If we are talking about international exposure and VXUS ETF, it appreciated only 3.86% on average yearly since inception. If we are talking about BND, the total bond market ETF, the return has been 2.79% on average yearly. In my opinion, those are awful considering nowadays we can use simple deposit accounts and get 4% without contract. So in my opinion, investors' goal, same as Warren Buffett's, should not be to become the best diversified investor in 30 years period, since here is no prize for that, but to become the best investor for total returns and for long-term safety. In my opinion, biggest goal every investor should live by is consistency and sustainability. I recently made a video about free ETF portfolio and it is the updated version of the old one and has been absolutely dominating the market and most likely is going to continue to do so for the future in my opinion. I will link this video in the end of this video so you can dive deeper if you are interested in becoming investor with best free ETF portfolio. Now, talking about the last mistake, this one is really the most biggest and hurting your portfolio growth the most. We just talked about fund overlap before, the importance of understanding what fund overlap is and at least how much overlapping you actually have in your portfolio investments. We also discussed that the best diversified portfolio is not necessarily the best option either and that we should be more concerned about long-term results and returns overall. Now, the third mistake is that as investors start learning more and more about different investment instruments, they start changing their strategy a lot, selling and buying, always hopping on the new trend or new strategy. The change is not the biggest issue, but the method is, however. Keep in mind that I'm not here to tell you what's correct or what's wrong, since each of you have different situations and want different outcome of your investment strategy. For example, REIT investments are amazing for one who wants a cash flow in forms of dividends, thus making him a passive income. But for one who is interested in more of a growing his portfolio and is younger, growth fund like QQQM might be a better option. So everything we are discussing here should always be filtered by no other than yourself. So the biggest mistake here to take someone else's opinion and copy investments blindly. Instead, you should add investments which you are interested in into a research list and then after understanding it fully yourself, decide if you are interested in adding it into your own own portfolio. In my opinion, free fund ETF portfolio is the best place to start because especially if you are new to investing or want to rebalance your portfolio, this video recently made, which is called Free ETFs that will make you ridiculously rich, will put you on the right track, and from there you can add your own twist. So I really recommend you to watch it next. If you found any value in this video, please like and subscribe. This does not cost you anything, but it really helps me to come up with new ideas and make those videos coming. Until next time.